Investment versus speculation results to be expected by the intellectual intelligent investor by Benjamin Graham. The chapter will outlay the viewpoints of that will be set forth at the remainder of the books and the particular wish to develop of an offset of us conserve appropriate portfolio policy. Investment versus speculation. What do you mean by investor? And throughout this book, the terms will be used to contradiction through the speculation. As far as 1983, it is our best book of security analysis. We attempt to receive a formulation of difference between difference between two is an investment is an operation in which one upon to analyzing promising safety of principal and adequate return. Operation is not meeting the requirement of speculative. While we have a club tenants in this definition. However, ensure that it isn't worthwhile noting the radical change that occurs in the use of the term investor during this year period. After the great market decline 1999-1932, all the common stocks were wide regarded speculation by nature. A leading authority stated the flatly that one day bonds could be bought for investment. Thus, we had then to defend our definition against the change that gives too wide scope to the concept of investment. Now, our concept of its opposite sort, we must prevent our readers from accepting the common jargon which applies a term investor to anybody and everybody in the stock market. In our last edition, we cited the following headlines of the front page article of our leading financial journals in January 1962. Small investors perish, they are selling odd lots short. October 1970, the same journal had an editorial critical of which called Reckless Investor, who is a time we are resting in our buying side. This quotation will illustrate the conformation that has been dominant for many years in the use of the word investment and speculation. Think of our suggestion defined of investment given above and comparing it while a sale of huge share of stock by an inexperienced member of public who doesn't even own what he is selling and he may largely emotionally conviction that he will be able to buy them back at a low price. It is not irrelevant to point out what when 1962 article appears, the market have already experienced a decline of market size and was now gathered ready for our even greater upswing. It was about a poor at time was possible for selling short. It is a more gentle sense a later used phrase a reckless investor could be regarded as an laughable contraction term. Sometimes it is in spendthrift mysteries, where the misuse of language were not so mischievous. Newspaper employ the word investor in the instance because it is a easy language of Walmart. However, who buys or who sells securities became investors, and regardless of what he buys and for what he purpose or what price or whether for cash or margin. Comparing this with the attitude of the public towards common stocks in 1982 when over 90% of the query expressed themselves as opposed to price of common stocks. About half gave us their reason not safe, a gamble. About half the reason not familiar with. It is indeed ironical ironical, though not surprised. This common stock purchases of all kinds were quite gentle regarding the high speculative or risky at a time when they are selling on the most attractive basis and due some soon to begin their greatest advance in their Troy in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels as judged by past experience later transformed them to investments and the entire stock buying public into investors. A distinction between the investment and speculation as a common stock has been useful one in the disappearance in cost to concern. We have often said that the Walmart as the institution would be well advised to reinstate the distinction and to emphasize it all its deal with the public. Otherwise, the stock exchanges may someday will be blamed for heavy speculation loss, which those who suffered them had not been properly warned again. Ironically, one more, much of the recent financial embarrassments of some stock exchange firms seem to have come from the inclusion of speculating common stocks in their own capital funds. We trust the trust that is a reader of the books will gain a reasonable clear idea of the risk that are inherent in the common stock commitments. Risk which is inseparable from opportunity of profit that they offer, and both of much all the lower of the investor calculation that we have just indicates that there may no longer be such thing as an Simon Shore investment policy and comprising representative common stocks, in the sense that one can always wait to buy them at a price that involves no risk of market or quotational loss large enough to be quite disquieting. The most period the investors must recognize the existence of speculative factors in a common stock holding. It is a task to keep the component within a minor limits and to be prepared financially and psychologically for adverse react results that may be the short and long duration. Two paragraphs should be added about the stock speculation per se, a distinction from the speculation components now inherent is a most repetitive common stock. Outright speculation are neither illegal nor immoral, nor most people faceting into the pocketbook. More than that, some speculation is necessary and unavoidable. For in many common stock institutions, there are substantial possibilities of both profit and loss, and the risk there must be assumed by someone. There is an intellectual speculation, there is an intellectual investment, but there are many ways in which speculations may be unintellectual. Of this foremost area are speculating when you think you are investing, speculating seriously instead of pastime. The lack proper knowledge and skill of it, raising more money in speculation than you afford to lose. In our conservative view, every non-professional who operates on margin should recognize that he is an ipso facto speculation, and it is in broker duty as to advise him and everyone who buys so-called hot common stock issue or buys or purchase any may similar thereof. In either speculating or gambling, speculation is always a fascinating. It can be a lot of fun while you are ahead of the game. You want to try your luck at it and put aside a portion of the smaller the better. Our capital is a separate fund for its purpose. Never add more money to this account just because the market has gone up and profits are rolling in. That is a time to think of taking the money out of your speculative fund. Never mingle your speculative and investment operation in the same account nor in any part of your thinking. Result to be expected by a defective investor. We have already defined the defective investor as one interested chiefly in safety plus freedom from bother. In general, that course should be followed. What return can be expected under average normal condition? If such a condition really exists, to answer these questions, we should consider the first what we wrote on the subject 7 years ago. Next, what significant changes has occurred since then, and underlying factor governing the investor expectedly. But and finally, what he should do when he should expect under a present day in early 1972 condition what he said 6 years ago. They recommend that if the investors divide his holding between high grade bonds and leading common stocks, that is, proportion held by bonds never less than 25% or more than 75%. With the converse being necessarily true form of common stocks components, that is simply choice would be made 50-50 proportion between two adjustment to restore their equality when market development has disturbed it has much as 5% of alternative policy. He must choose to reduce his common stock component to 25% if he feels the market is dangerously high, and conversely to advance in towards a maximum 70% if he felt that the decline of market share price was making them increasing attractive. In 1970, the investor could obtain about 4.5% high create taxable bonds and 31 to 4% on goods tax-free bonds. This dividend return on the leading common stocks within DJIA 892 was only about 3.2%. In fact, that other suggested cautious we impute that a normal level of market investors should be able to obtain an initial dividend return between 3.5% to 4.5% on a stock purchase, to which would be added a steady increase in underlying value, and it is a normal market price. It's a representative stock list of about the same amount, giving and return of dividend and appreciating combination of 7.5% per year. This half and half dividend between bonds and stock would yield out 6% before income tax. He added that the stock component should carry a fair degree of protection against a loss of purchasing power caused for large scale inflation. It would be pointed out that is above the arithmetic indication expected of much lower rate of advance in the stock market, and that had been realized between 1949 and 1964, that the rate has averaged a good deal between better than 10% of the listed stock as a whole. It is a quite gentle regarded as short of guaranteed similar satisfactory result would be counted on the future. Few people are willing to consider seriously the possibility that high rate of advances too in the past means the stock price are now too high, and hence the wonderful results of since 1914 impute not ever very good but bad result for the future. What has happened since 1964? The major changes 1964 has been the rise of interest rate and a first grade bonds to record high levels. Although there has since been a considerable average recovery from the lowest price of 1970, the obtainable return on good corporate issues now 7.5 percentage and ever more again 4.2% in 1974. I maintain the dividend return on DGIA type bonds as a fan advantage. Also during the market decline 1969 to 70, but as we write with the Dow 900, it is less than 3.5% against 3.2% they enter 1964. The change some interest rate produce a maximum decline of 38% of market price and medium terms over 20 years during the period. There is a paradoxical aspect of this development. 1964 was discussed the length of possibility that the price of stock might be too high and subject ultimately to serious decline. But we did not consider specifically the possibility that the same might happen to the price of high grade bonds. Neither did anyone else that we know of. We did one at pre-1965 edition that long-term bonds may vary widely in a price of response to changes in interest rate. In the light of what has since happened, we think the warning with attendant an example insufficient stress for the fact that as a must had given some of DGIA at a closing price of 874 in 1964, we would have a small profit there from the late 1971. Even at the lowest level of 631 in 1960 70 was indicate loss that would be less than shown as good long-term. On the other hand, if he had confined that bond type on investment in US savings bond, a short-term operate issues, or a savings account, he would have no loss in the market price of the principal during the period, and he would have enjoyed a higher income return than offered by the good stocks. In terms of therefore the true cash equivalents proved the better investment in 1964 in the common stocks in spite of inflation. In the experience that theory would have favored stocks over cash. Decline in the quota for principal level of goods longer term bonds was due to the development of money markets, an observed area where ordinary does not have an important bearing on investment policy of individual. This is another endless series of experiences that over time have a demonstrated that the future of the security price is never predictable. Although always bond have fluctuation among less than stock price, and investors generally would buy goods bonds for any maturity without having to worry about the changes in the market value. There are a few exceptions to the rule. The price period of 1964 proven to be one of them. We shall have more to say about the change in the bond price in the later chapters. expectation and policy in the late 1971 and the early 1972. Towards the end of 1971, it was possible to obtain 8% taxable interest on the good medium-term corporate bonds and 5.7 tax-free on the good state and municipal security. In a short-term field of investment, realized about 6% of U.S. government issues due to 5 years. It is a later case buyer need not to concern about the possible loss in the market value since he is sure to full repayment, including 6% interest return. At the end of this comparison, short holding period DGIA was a recurrent price level of 900 in 1971 yields only 3.5%. Let us assume that now, as to the past, that basic policy decision as to made is how to divide the funds between high grade bonds or other so-called cash equivalents and leading DGIA type bonds, and what course should be investor follow under the pressure condition. If we had no strong reason to predict either a significant upward or a significant downward movement of some type of the future, first let us point out, if there is no serious adverse change to the defective in the investor should be able to count out the current 3.5 dividend return on the stocks and also on the average annual appreciation about 4 percentage. As we shall explain later, the appreciation is a basic essential on the reinvestment by the various companies of corresponding amount annually out of undisputed profit on the before tax basis of combined return of the stocks would then average a 7.5%, somewhat less than the interest on the high grade bonds. On an after tax basis, average from the stock would be work out at 5.3. This would about the same as now obtained good tax-free medium-term bonds. These expectations are much less favorable for the stocks against a bond that has been about 1964 dollars. That is the conclusion follow the inevitable for the basic fact that bond yield have gone up much more than the stock yield 1984. We must never lose sight of the fact that the interest and principal repayment on good bonds are much better protected and therefore more certain than the dividend of price appreciation on the stocks. Consequently, we are forced to conclusion that now, towards the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion right, we could have to advise the defective investor to put all the money in the bonds and none in the common stocks until the current yield relationship changes significantly favor of stocks. But of course, cannot be certain that bonds will work out better than the stocks from today's level. Readers will mostly think of the inflation factor of the pocket reason on the side. In the next chapter, we will argue that our considerable experience with the inflation in the United States during the century would not support the choice of stocks. Again, the bonds are sent differently in the yield, but there is always a possibility, though we consider it remote, for accelerated inflation, which is a one way another would have no make stock equities preferably in bond payable in the fixed amount of dollars. There is an alternative possibility which is also considered highly unlikely. American business will become no profitable without stepped up inflation as to justify a large increase in common stock values in the next few years. Finally, there is a more familiar possibility and it shall witness another great speculation rise in stock market without a real justification underlying values. Any of this reason, perhaps around others we haven't thought of, might have investors to regard 100% concern of the bonds even at the more favorable yield level. Hence, after the foreshortened discussion of the major consideration, he would again encumber the same basis of comparison policy for defective investments, namely that all the times they have significant part of the funds in the bond type holding and significant part also equities. It is true that many choose between maintaining simple 50-50 division between two components, a ratio and dependence of judgment varying between the minimum 25% maximum 75 is in either. He shall give you more detailed view of this alternative policy in a later chapter. Since present, the overall return of investigated the common stocks nearly the same as the bonds, and presently expected return includes a growth of stock value for the investor who changes its little regardless of how he divides his funds between his two components. As calculation above, the aggregate return from both the parts could be 7.8% before the taxes or 5.5% tax free. They estimate the tax period basis as a return on order of appreciable higher than the realizable typical conservation investment over most of the long-term past. It is not seen attractive in relation to 14% or so. Return showed by the common stock during 20 years of the predominantly bull market after 1949, but would be remembered that between 1949 and 1969 the price of DGIA has advanced more than fivefold while its earning and dividend and had doubled. Hence, a greater part of the impression market record for the period was based on the change in investors and speculators. The attitude rather than unliking corporate values to the extent might well be called a bootstrap operation. The distinction of the common stock portfolio of defective investor, we have spoken only the leading issue of type of including a 30 components of Dow Jones Industrial Average. We have done this conversely and not impules that the 30 issues alone were suitable for purchase for them. Actually, there are many other companies of quality equal to or excelling the average of Dow Jones list, and that would include the host of public utilities, which have a separate Dow Jones average to represent them. But the major points here is to define the investors' overall result as not likely to be a decisive different from one deviation or a percent of list from the other, not more accurate that neither he nor the advisory could predict within the certainty of whether difference could be ultimately developed. It is true that the art of skilled and skewed investment is supposed to be a lie, and particularly its selection of issues that will use and better result than to general market for the reason to be developed elsewhere. We are skeptical of the ability to defective investors generally to get better than average results, which is a fact would means a bit their own overall performance over speculatively expected to be management of large funds of the experts. Let us illustrate our point of example that first may seem to prove the opposite. Between December 1960 and December 1970, the DJI advanced at 6162 is 839 at 36%, but the same period, much larger Standard and Poor weighted index and 500 stocks rose from 58.11 to 92.15, 58%. Obviously, this second group had proved better by than the first, but who would have been so rash was to predict in 1960 that is a scene with the miscellaneous assessment of all sort of common stocks would definitely outperform the aristocratical 30 triads. On the two, all the proofs we insist that only rarely can one make dependable prediction after a price changes, absolute or relative. He shall repeat here without apology, for the warning cannot be given too often that the investor cannot hope for better than average result for buying new offering or a hot issue of any sort, meaning thereby this recommendation of a quick profit. And the contrary to is most certain that to be true, it is in long run. The defective investor must confine himself to the shares of the important companies with a loss record of profitable operations and a strong financial condition. Any security analysis would result to make such list. Aggregate investor may buy other types of common stocks, but they could be the definitely attractive barriers of established by intelligent analysis. To conclude the section, let us merely brief three supplementary concepts or a practice for the defective investor. The first is the purchase of the shares of well-established investment fund as an alternative to creating our own common stock portfolio. He might also utilize one of the common trust funds or a coming coming late funds. This operated by trust companies and banks many states as if the funds are substantially use the services of a recognized investment consult firm. This will give them a professional administrative of this investment program along the standard lines. The third is the device of dollar cost averaging, which means simply that the particular practitioner invested in the common stock that some new numbers of dollars each month and each quarter is where he buys more shares when the market is low. Then when it is high, then he is likely to end up with the satisfactory overall price for all his holdings. Strictly speaking, it is method is application of the approach known as for multi investing. The latter was already alluded to any of the suggestion that the investor may vary his holding of common stocks between 25% minimum and 75% maximum. This investor relationship is a reaction of market. This idea has been meritorious and defective investors, and this will be and defective more amply in later chapter. Result of expressly default of expected to be aggregative investor. Our enterprises security buyers of course will desire and expect to attain better overall result than the defective or passive compression. But first thing we should make sure that the result will not be worse. It is not difficult trick to bring a great deal of energy, study and a native applicability to Wall Street and end up with the losses instead of profit. This virtues is channeled in the wrong direction because of the indistinguishable of handicap. Thus, the most essential that the enterprises investors start with a clear concept as to course of action, offer reason of changes of success and which do not. First, let us understand several ways in which investors and speculators generally have endured to obtain better than average result. These include trading in the market. Trading in the market they usually means buying stocks when the market has been advancing and selling them after the time downwards. These stock selections are likely to be among those who have which has been behaving better than the market average. A small number of professionals frequently engage in short selling. Here they will sell issues and they do not own but borrow them and establish a mechanism of the stock exchange. The subject is to benefit from the subsequent decline in the price of this issue by buying them back at the market lower than they should sold them for. As for the quotation for the Wall Street Journal indicates, even a small investor perishes at term. Sometimes try them unskilled hands or short selling. Short-term selectivity. This means buying stocks of companies which are reported or expected to report increasing earning or for which seem other favorable development of anticipated. Long-term selectivity, where the usual synthesis emphasis of an excellent record of past growth, which is considered likely to continue to future. In some cases, also the investor may choose companies which have not yet shown impressive results, but were expected to establish a high earning power later. Such companies belong frequently some of the technology example, computer drugs, electronics, or they often developing new process and produces that are deemed to be established promising. We have already expressed a negative view about the investors' overall changes of success in these areas already. In the first, we have a ruled out but theoretically and realistic grounds for the dominant domain of investment. Stock trading is not an operation, which are throughout the analysis offer safety of principles and satisfactory return. More we said on stock trading is a later chapter. In this endeavor to select the most promising stock either for this near term or longer future. This investor faces obstacles of two kinds. The first stemming from human fallibility and the second from the nature of this competition. He may be wrong in the estimate of the future. Even if he is right, the current market price may already fully reflect what is anticipating in this area of a long-term selectivity. The current result of the companies are generally common property on the Wall Street. Next year results shows to extreme that this predictability and already being carefully considered. Hence, the investor who settles in issues they chiefly on the basis of this year superior result as for what is told may expect the next year. It is likely to find out the other have done the same things for the same reason. In choosing a stock for the long-term prospect, investor handicaps on basically the same. The possibility of the outright error is prediction, which is illustrated by our airline example here, are no doubt greater than when dealing with the near-term warning. Because of the exports frequently go astray in such forecasting, it is theoretically possible for the investor to benefit greatly by making correct prediction when the Wall Street whole is making incorrect ones. But the only theoretical how many enterprising investors would count on having accurate, promptly gifted to beat the professional analyst at the favorite games of estimating long-term future earning. We are thus lead to following logical conclusion to enjoy the reasonable chance of continuing better than average result. The investor must follow the policies which are inherently sound and promising and not popular in Wall Street. Are there any policies available for enterprise investor? The theoretic ones, the answer should be yes. And here is a broad reason to think of the answer to this affirmative practice as well. Everyone knows that speculative stock movement is carried out for two directions frequently in the general market. At the times, the least somewhat indicate issue. The furthermore, the common stock may be overvalued because of the lack of interest or justified popular production. We can go further and ascertain that the astonishing large proportion of trading as common stocks is engaging appears to no bullet terms. One part is anatomy from another.